Good morning and welcome to CFRA's second half outlook. I'm Ken Leon, the moderator for today and Director of Equity Research. With us is a great lineup of our leading thought leaders: Sam Stovall, Chief Investment Strategist; Vincent Randazzo, Head of Technical Research; Angelo Zino, Vice President, Equity Research, heading up our technology fundamental research; and Nick Rodelli, founder and head of Legal Edge. Also with us is Dawn Yang. She is our CFRA marketing coordinator for this event. And let's move to the next slide. Standard disclaimer: this presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. Next slide. For those who aren't familiar with CFRA, here is a great timeline that shows our capability and our long history as a leader, the largest independent research provider. And as you can see here, in the early years, CFRA was in risk metrics, also acquiring additional capabilities in that area in 2010. And then the fundamental research team from S&P Equity and Fund Research came on board in October 2016, and we have expanded with tremendous capabilities. In 2018, the acquisition of FirstBridge for ETF data. We acquired Lowry Research, which was Vincent's team, and that gave us world-class technical research. And then this year we acquired Washington Analysis for policy research that we have coming out of Washington. So we're very proud of our position and also the analytical quality and depth of our research. Next slide, please. So this is really the flywheel in terms of our research and how it's created. It's able to, at all levels, be able to provide investment views and perspectives on market commentary, obviously leading with Sam, who provides leadership for us also in our direction and views for sector research, as he'll show today, and also the bottom-up research that is done by our fundamental research team, covering 1,500 global companies on a qualitative basis, and also providing views about different industries as well. We find that our customers benefit from the scale of our research, but also the quality and also the collaboration we have across the different research regimes, whether it be Vincent's team on technical research, also Nick in terms of legal, as you'll hear Nick speak about his views of the mega cap companies or stocks in technology, and then also to make sure you get all of our research IQ, the idea generation that we are delivering in these areas, as well as our leading forensic research team. So it's a very exciting time to be at CFRA to serve you in these volatile times. Next slide, please. So with that, let's get to our program. Sam Stovall, Chief Investment Strategist. Good morning, Sam.
Good morning, Ken. Good morning, everybody, and thanks for tuning in. I am going to talk about what is going on currently in the market and where we see the market going for the remainder of this year. So, Dawn, let's take a look at the first slide to sort of tell people what they already know, and that is that the S&P 500 down almost 22% since the January 3rd high. We have seen essentially all styles, all sizes in negative territory, and 10 of 11 sectors posting red ink, except for energy. We're also seeing 15% of the 148 sub-industries in positive territory, so essentially 85% in negative territory as well. If we could go on mute, everybody, then we could get rid of the background noise, please. What I find is that history told us that we needed to be aware that we were going to fall into a decline, a meaningful decline of at least 5% or more, because in 2021, the S&P was up by 27. And any time since World War II, then the market was up by 20% or more. We did fall into a decline, averaging 11%. However, this one has been deeper than most. And so certainly the question is, what is it that's causing investors to be so concerned? Let's take a look at the next slide and we'll see what those concerns are. It's basically the rising risk of recession. We've been seeing reductions in GDP growth estimates. We're certainly on the leeward side of this earnings growth curve. The S&P 500 posted a 44% increase in earnings in 2021, is now expected to post a sub 9% growth this year. Most of concern, however, is that Fed funds, 2 out of every 3 times in the beginning of rate tightening cycles, Fed funds rate has been higher than the year-on-year percent change in CPI. However, this time around, CPI is higher, and also it was higher by 750 basis points, the highest on record. We've also again seen inverted yield curves, which tend to precede recessions by an average of 14 months. And we certainly see that the defensive and inflation-hedged sectors are doing very well in anticipation of a slowdown in economic activity. Let's go to the next slide to see by how much the economists are forecasting a reduction in GDP, as well as higher interest rates, higher inflation, et cetera. On the left-hand side, we see that Action Economics is projecting a 2.8% rise in real GDP for the US, but that's down from the 4.6% gain expected as of the end of last year. And it's not just the US, it's globally, it's the advanced economies, the emerging economies, as well as individual areas and countries. In particular, China is expected to see a slowdown. So it's a broad-based, across-the-board reduction in GDP forecasts. Our economists, however, are not anticipating a recession at this point, but if you look to the right-hand side, you can see that inflation, looking at the year-on-year headline CPI, Q4 versus Q4, expectations are that inflation will remain stubbornly high and average 7.1% by the end of this year. Fed funds rate expectations are for at least 50 basis point increases in July and September, with 75 basis point increase today. 10-year note, this is a moving target, but the most recent estimate was 3.2%, with the US dollar remaining firm and oil prices also remaining challenges. As we see in the next slide, investors have been positioning themselves quite defensively. This is a chart showing the 11 sectors within the S&P group of global indices, the 500, mid-cap 400, small-cap 600, Canada, Europe, and in Asia. And this is a 200-day look back. So basically at the end of each month, looking back essentially 9 months to say which is the strongest, which are the weakest sectors. And you can see that weakness has really been pronounced in the growth areas of communication services, consumer discretionary, and tech. And then surprisingly, in one of the more defensive areas, healthcare. But definite strength has been found in the inflation hedge areas of energy and materials, as well as the more defensive areas of consumer staples and utilities. One reason I believe that this leaning has been taking place for over the past several months is, as we see on the next slide, is the true concern that investors have with inflation and how it does tend to precede bear markets and recessions. This is a chart, the jagged blue line is simply a year-over-year percent change in headline CPI, easily downloaded from the Bureau of Labor Statistics. What I show is the average. I show 1 and 2 standard deviations above and below the mean. Light blue shading are bear markets, and then the orange darker shadings are recessions. what I have found is that the 5 times that we did see the year-on-year percent change in headline CPI touch or exceed 1 standard deviation above the mean, or essentially 6.5%, that in every one of those times, not only did we have a bear market, but we also slipped into recession. Now, that's obviously not a guarantee, but if 5 of the last 5 times that this happened, one might be concerned that it will happen this time as well. Certainly, we got 1 out of 2, so we do have the bear market. The real question, therefore, is do we slip into recession? As I mentioned, our economists are not forecasting such just yet, but the stock market and certainly the trend in inflation says otherwise. Let's take a look at the next slide. Assuming that we do end up with a bear market accompanied by recession, what has happened in the past? Well, unfortunately, what we find is that bear markets tend to last longer and fall farther when associated with recessions than not. Since the late 1940s, there have been 12 bear markets and 12 recessions. And 9 of those times we saw bear markets with recessions. 3 times we did not, 1962, 1966, 1987. And what we find is that when we do have a bear with a recession, the average decline lasted 15 months versus 6 months for those without recessions, and that the average decline was 35% versus 28% for those bears without recessions. Now, obviously, 35% is an average. We have instances like 48, 56, like in 1990 and even 1980, when we saw bear markets that ended up being in the low to mid 20% range. I say that because our estimate is that we do move down to about 3,500 for the S&P 500. I come up with that based on a Fibonacci retracement level. Sorry, Vincent, don't mean to be stealing your thunder. But also looking at PE contractions. On average, we find that valuations for the stock market have been cut by 1/3 on average when we have bear markets associated with recessions. We started 2022 with a trailing PE of close to 23 times. Reducing that by about 32%, we come up with a PE of 15. And the only question is 15 by what? Meaning by how much will the earnings actually be coming down as we move into a slower economic growth environment? Right now, the PE, revised PE against current estimates point to about a 35-50 level on the S&P 500, but certainly that number could be coming down. Let's take a look at the next slide, which shows that many of the areas that we look at, certainly for the second quarter, have been revised lower. Again, I'm showing the 11 sectors in the S&P 500, and this is S&P Capital IQ consensus data. The white columns show what were the estimates on March 31st of this year. The blue columns show what is the current estimate. And as you can see on the very bottom, the market was anticipating a 6.3% growth in second quarter earnings. Now that forecast is for a 5% advance. Revenues have been picking up, however, but profit margins have been coming down. So you can see that in the blue column for the profit margin area, now we're seeing many of the sectors that had been expected to post positive profit margins are now expected to post negative ones. For the full year, the number remains stubbornly high at 8.8% versus the March 31st forecast of 7.7%. So we'll have to wait and see in the second quarter reporting period what kind of adjustments are going to be advised by company management. Digging a little bit deeper in the next slide, what we find are looking at tech sub-industry second quarter earnings estimates. These too, on average, tend to be revised lower. Not everybody, however. We saw Oracle come out with very good results. Not surprising that application software has done relatively well. System software also doing a little bit better in terms of earnings. Electronic components have been seeing a 1.7% upward revision to their second quarter estimates. Semiconductors also down 0.8, but that's certainly better than the market as a whole, down 1.2. But as we slide down to the right-hand side, you can see that semiconductor equipment, communications equipment, et cetera, have been seeing deeper and deeper downward revisions to estimates. But as things go on sale, a lot of investors say maybe now is the time to be thinking about buying. So let's take a look at the next slide, which shows absolute and relative PE ratios for the sectors within the S&P and the market itself. And you can see on the very bottom that the S&P, this being as of the 13th, was trading at 16.7 times forward earnings, a shade below the average of 17 going back to 2000. But as I mentioned, in bear markets, typically we don't just go to the average, we tend to go below the average. Right now, tech is trading at 20.2 times forward earnings versus its normal 21.8, or a 7% discount to its absolute PE. And versus the market, it's trading at a 9% discount to the overall market. So possibly when these numbers come down a little bit more, they can look increasingly attractive for investors. So finally, let me just summarize in the next slide by saying 2022, a midterm election year, is normally a sophomore slump year and has the greatest variability in terms of price action and typically the lowest return of the four-year presidential cycle. We are possibly headed for a recession, and we're certainly already in a bear market. Fundamental forecasts have begun to be reduced and I think will continue to be trimmed. But I am also a very big believer in using stock market history to serve as virtual Valium, reminding investors how quickly the market tends to recover from such sell-offs. So I tell those investors with long-term time horizons, this too shall pass. And indeed, look for investment opportunities. In particular, is it time for tech to turn? So with that, let me pass it over to an expert in the technical area to see whether Vincent agrees with some of the amateurish recommendations that I've been making. Vincent?
Thanks, Sam. Excellent insight there. Nothing amateur about it. Again, glad to be here with you and our whole panel of experts today. I think it's really going to be great. I'm going to be going into and approaching the market from the perspective of Lowry's proprietary form of technical analysis, one that is focused on evaluating the forces that drive and therefore lead the major price indexes, not just the price indexes themselves. So let's start with the first slide, please. In terms of the big picture, our core indicators reflect a weak and still worsening market condition that's consistent with an ongoing longer-term downtrend or bear market. The middle indicator here is the net difference between Lowry's intermediate term measures of demand, buying power, so what we call buying power, and supply, what we call selling pressure. It defines the investing climate, okay? When it is falling, and particularly when it's below its 40-week moving average and falling, as has been the case since about July of last year, it signifies an increasingly difficult and dangerous investing environment. Now, when it's rising and above its long-term moving average, it's relatively easy to make money in stocks. Everybody's a genius, right? This indicator showed its first negative divergence in February of 2021. Well, when was that? Well, it started when the growth stocks topped out. You know, a lot of those growth stocks and more speculative issues, they dropped out of the bull market at that point, or at least they started to do that. And divergences, just kind of backing up here, are when the indicator does not confirm what the price index is telling you, okay? Now that downtrend in our indicator intensified as the bulk of small and mid-cap stocks also started to reverse their course about a year ago. Now, despite some short-term stabilization, I think you can see in that chart there, the downtrend is still intact. Okay, so the trend is still getting worse from a longer term perspective. And it's important to remember this is not a market timing indicator by any means. It's really just useful in detecting the changes in the overall investing environment that would frankly otherwise been basically invisible in the large cap price indexes until it's too late, right? In the bottom panel on the same chart, we can see that Lowry's average power rating, or APR index, demonstrated the same negative divergence or warning into January's all-time high. The APR index being the average Lowry demand score for about 3,500 stocks in our database is a great measure of both breadth, in other words, how many stocks are participating in the bull market, and demand intensity, or to what extent those stocks are participating. The APR index, as we can see, remains on a clear path of lower lows and lower highs, with the most recent low confirming the mid-May market low. Now, something to watch in coming weeks will be if this indicator can form a positive divergence against the price indexes. In other words, if the APR index were not to hit a new low with the indexes. This would be among the early signs that a real bottoming process could be underway, but we've got to wait to see it first. On the next slide, I'll cover more detail about stock market breadth, or what we like to call stock participation. So while breadth is typically only measured by the New York Stock Exchange all issues advanced decline line, or at least historically, if you look outside of Lowry, our analysis takes it further. Since the NYSE advanced decline line is heavily populated by preferred stocks, closed-end bond funds, and ADRs, it can sometimes track the health of the bond market better than the stock market. Then, with the understanding that historically it is often the small caps that lead the charge to the downside, Lowry also examines breadth by market cap segment. So that's what we see here in this chart, with large caps being on top, mid caps in the middle, small caps on the bottom. And like the classic pattern, small cap breadth peaked in June of 21, right? About a year ago. Then mid caps in November, and large caps were the only segment to confirm the January high. And there's a good reason for that. That's because large cap stocks represented most of the stocks still rising by then. And of course, you've got market cap weighted indexes. So we can see that all three market cap segments, as it stands, are in downtrends in terms of breadth. Even though the once bulletproof large caps, which all confirms the now dominant market trend, which is a downtrend to the downside. The next slide, we're going to illustrate the price impact of this cascading breadth deterioration. Now, breadth is great to understand, but it's limited since it only tracks directional participation, right? Not the associated intensity or weakness under the surface. Lowry's percent of operating companies only 30% or more below 52-week highs measures the latter. As the S&P 500 hit its high on January 3rd, the percent of stocks 30% or more below 52-week highs was already at 17%. So a new all-time high in the S&P, and almost a fifth of stocks were in deep drawdowns. This pattern is common in major market tops, as the weakness that was spreading under the surface of the large cap price indexes is hidden by the market cap weighting of those major indexes. While gradually rising for about a year now, this figure didn't really ramp until recently, hitting a new multi-year high of over 44% just the other day on June 13th. Now, in the last 20 years covered on this chart, once it moves above about 33%, there have been spikes shortly after, ultimately representing selling climaxes, what you call a selling climax, and eventually a market bottom. That level, 33%, that was breached on April 26th. So the point is that this indicator doesn't historically reverse down, signaling a lasting low without spiking first. And if history is any guide, we're just not there yet. On the next slide, we'll see that some of those long-term indicators that we've been talking about and how they look at the market conditions, some of the remaining indicators in terms of market momentum. So consistent with the conclusions of Lowry's core indicators, our measures of market momentum simply confirm what we've been seeing. Now, what we're doing here is just looking at how many stocks are in long-term uptrends, how many stocks are making new lows versus new highs. Really the most basic but most important characteristics of any market trend. So it's important that we watch these very closely. Lowry's percent of New York Stock Exchange issues above 10 and 30 moving average have been in decline since spring of 21. So it's been over a year now. And of course, part of that time, prices continued to rise. So once again, this was indicative of an increasingly unhealthy market condition as fewer stocks were able to maintain uptrends. At the same time, the 5-day moving averages of stocks hitting new highs contracted, and then those making new lows expanded. So with new lows in each of these indicators coinciding with the latest market lows, it reasserts that market downtrend. And like all the indicators we discussed so far, without being totally washed out, they take time and really a significant effort on the part of buyers to shift the probabilities back in favor of the bulls. The figures on this chart, we should note, are calculated on Thursday nights, so we'll have to see if further lows were reached to confirm or question the downtrend. And to this point, as I mentioned earlier when we discussed the APR index, positive divergences are going to be something to watch for in the coming weeks and months to signal a potential character change or important trend change otherwise. So what are these washout conditions that I keep talking about that are absent, that act as tinder to spark the new bull markets? Well, let's go to the next slide and find out. What we see here is Lowry's weekly momentum indicators back to 2008. And what we can tell from that is that there is no set price decline associated with a major market bottom. Similar to what Sam mentioned, there are always a range of outcomes when it comes to bear markets. And for as many helpful indicators there are for identifying major market bottoms, there are no indicators that can forecast the depth and duration of a bear market. So I think that's really important. And it's important to remember when it comes to patience and waiting for the right conditions to be in place under the surface. But there are common threads. If we look at Lowry's percent of New York Stock Exchange issues above their 10 and 30-week moving average, they tend to be in the teens before providing enough of those irresistible bargains for investors to come and swoop up. Now, these are built from our own NYSE universe, not the generic NYSE composite data that you might find elsewhere. So that's just important to remember. As of last Thursday's close, both figures were just about 30%. So again, we're going to have to wait for this week, Thursday night, to see if how much this changes and if we're actually in that green zone, in that dotted line that I've drawn into those charts. Also, our APR index discussed earlier is often at least 30 or below, and our short-term index, Lowry's calculation of short-term market demand and a historically great measure of long-term oversold conditions, is below at least 60. Currently, all of those indicators are well off these levels. Even as of the lows in mid-May, none of those indicators were in the vicinities from which durable new bull markets were typically born. Now, once in oversold territory, another factor that would increase the conviction of a bottom would be a positive divergence or positive divergences in some of these indicators. Just like negative divergences are formed because stocks top at different times, stocks also tend to bottom separately, though in a tighter time frame. So the divergences are not going to be as long. But that sometimes makes positive divergences early signs of a lasting low. But until at least some of these conditions are observed, any short-term advance that develops has an elevated chance of failure. So it's not that the market has to bottom in a certain way, right? It's that based on our observations since 1938, if the classic bottoming conditions are not present, the probabilities of a bottom are historically just much lower. And as a result, a higher burden of proof must be met in terms of reversing those downtrends, right? And this brings me to my final slide, the conclusion, tying it all together. The bottom line is that the trends in Lowry's core indicators reflect an ongoing period of market weakness with little evidence that a sustainable bottom has been put in place. In keeping with historical tendencies, our analysis continues to suggest that the most likely resolution will be a further market decline, which meets longer-term oversold conditions before finally being met by a wave of all-inclusive investor demand. In other words, people will want to buy all stocks again, not just energy stocks or some defensives, everything. Since the risk right now of further decline outweighs that of a delayed market reentry, we believe that patience and defensive measures continue to be the most logical stance. So that's all from my perspective. I'll look forward to your questions later, and to that end, at any time, please feel free to type in your questions into the chat box of the webinar that you'd like to have any of us answer. But up next is Angelo Zino, CFRA's technology sector analyst, for a closer look at that area.
Great, thanks a lot, Vincent, and hello, everybody. So like Vincent said, I'll provide some high-level views on tech, but the conversation primarily going to be geared towards semiconductors. So if you turn to the next slide, is tech in the midst of a growth scare, or is this a bubble like the dot-com era? And we think the former remain overall constructive on large cap tech with a focus, of course, on GARP mentality. So you, of course, have a slew of near-term headwinds, right? We all know about them. Inflation, rising rates, crushing multiples within tech as of over the last 6 months, a stronger dollar for large international companies. You've got supply constraints lingering, China demand weakness, of course, Russia, Ukraine, and concerns about the shifting consumer spend towards areas like travel and away from tech as of late. But all that said, digitalization really is at its highest point since the dot-com era, really driven by greater investments in AI, in the cloud, and across all markets for that matter. So as far as tech is concerned, we think tech should fundamentally at least perform better than other sectors on a relative basis as global economies slow down because of the sector's greater exposure to the cloud and enterprise. I'd also note that within tech, yes, we're clearly seeing some signs of decelerating growth, especially after the last 2 years. But the secular trends overall remain intact. It's possible we're talking about peak oil prices or peak travel at some point in the future, but one thing I promise you won't hear about is peak cloud demand. And listen, investments in tech, we think it won't stop for two major reasons above all things. One, data growth will not stop. You're kind of growing at north of a 20% annual clip, especially as more connected devices enter the world. And then two, tech is deflationary in nature. You invest in the cloud or factory automation or anything else in tech in order to drive your costs down. And then this is an environment where that is more important than ever. So next slide here. This is just a quick chart on tech performance versus the S&P 500 over the last decade. It's interesting that the three biggest pullbacks since the financial crisis in tech have actually come in the last 4 years. The current decline is actually the longest tenured since the financial crisis. It's done a ton of damage on the valuation side, which to us is very worrisome. Market finally has opened up that Pandora's box on high tech valuations. I think it's also important to note the relative underperformance in tech versus the S&P is the most severe we have seen over the last 13 plus years. So on the next slide here, all the tech pain here over the last 6 months, you can see I'm really coming from PE's multiples compressing down about 33% from the end of last year. And Sam alluded to how tech estimates have come down since the end of Q1, and recent commentary from off-peak tech companies would imply kind of a very tough Q2 earnings season, and potential earnings cuts are probably needed for 2023. I would expect to see the greatest challenges from consumer-driven companies, given the commentary from retailers, while supply chain headwinds, we think actually likely hit a maximum pain point in April, May. I think the good news is for many cloud-exposed companies out there across tech, backlogs are actually still growing. So it's not as if demand has or necessarily will dry up. One other point I'd make here is that the last two major pullbacks in tech in the broader markets bottomed out around the forward P of 15 times, where tech multiples kind of gravitated towards your market multiples in both those instances. However, I think it's important to note that Apple, Microsoft now represents over 45% of this index. So it might be tough to kind of get back to those levels, just given the changing business models and the massive free cash flow they produce. The next slide. Now, this is just a slide on forward valuations post-pandemic compared to pre-pandemic across different industries in tech. And, semis and software have seen the greatest multiple compression, down at least a third across both those categories this year. Nonetheless, we have essentially seen forward multiples now revert all the way back to pre-pandemic levels across all categories. And, take that orange line, which is software, for example. We've now reverted to the low to mid 20 PE range seen from 2017 to 19. Semis, IT also have reverted all the way back. The only industry, again, that hasn't is hardware, which is all Apple. And once again, just given that changing business model to services. Next slide. So that was, tech at a high level. I just kind of want to now move to, to semis. I'd love to talk about semis for the next hour, but really kind of need to keep my comments at a high level here. I only have a few minutes. This is basically my conclusion slide up front. Semis for many are the value segment of tech. And, although in recent years, I'd say many growth-oriented names have risen to the top, so NVIDIA, AMD, and Marvell. But over the next few slides, I'll talk about where we're in the cycle. But the secular opportunities overall remain very enticing, as we kind of, we're projecting the market growing to over $1 trillion annually by 2030. That's nearly double the pace that we kind of saw last year. So we're implying about, semis grow about 6 to 7% long term. Overall, we've seen mixed results during Q1 earnings season, with recent earnings revisions really on the downside coming largely on the supply side of things, logistics into China, as well as Russia, Ukraine, and COVID China related on the demand side, so everyone being trapped at home. But buy-side investors, we think, within semis have largely been on this buying strike, and most are really waiting until we see those estimate cuts really more focused on the demand side rather than related to supply issues. But despite all that, all the worries in the market today, history does say recent declines in the current multiples are very enticing for long-term investors. And next slide here. In this table here, I just compare the most recent decline to prior semiconductor corrections, 9 total in the last 15 years. This is actually the longest tenured downturn we've had since the financial crisis for semis, over 144 days, with the average chip stock now losing about a third of its value since the December highs. Now, we're mindful of the mounting economic risks that are out there, but also highlight that the semiconductor stocks, more so than any other segment of the market, typically discount issues well in advance of expected consensus estimate cuts. And stocks in this category have been known to kind of climb that wall of worry after you see those initial cuts. So, essentially prices lead fundamentals, and we all know that. But I think 2018, 2019, the downturn there within semis actually was a great example. So semi stocks tanked in late 2018 ahead of an expected industry downturn in 2019. But semi stocks actually on average rose over 60% in 2019. And that was a year where semi sales were down 12%, which was actually the worst year for the semiconductor industry since the financial crisis. The next slide. So here, just a slide on semiconductor valuations. You can see they've compressed over the last 18 months. Makes a lot of sense as the cycle continues to get longer in the tooth. We're now 10 quarters into an upcycle that usually lasts 8 to 11 quarters. Ultimately, tougher comps, lower end market growth will lead to a period of softness. You can see from this chart that semi valuations now are at the lower half of its trading band seen over the last several years and near the trough valuations seen in prior cycles. So clearly we can see, if macro concerns intensify, things could set up a greater fear environment for chips, similar to what we saw during the pandemic and the tariff bottom in 2018. But in both those cases, multiples on average got to about 12 to 14 times. And that range has a lot of support at those multiples if you stretch this back 15 years. Today, the average semi multiple is about 13.7 times. Usually, you kind of get a snapback that's very aggressive when you hit those bottoms. So I don't recommend anyone actually try to call a bottom. Now, next slide here. This just shows, our quarterly run rate forecast for semis. You can see the orange line. That's the growth rate for semis. It typically drops sharply after peaking, which we think was actually the case in Q4. Again, growth rate, not sales. So by the first half of 2023, we think semis run more seasonally in nature and could set up 2 quarters of negative year-over-year growth. So this is essentially our base case scenario. Data centers right now, really offsetting the PC and smartphone softness, but the tough comps in 2023 is probably what gets in the way for data centers. Think of it as a period of digestion similar to what we saw in early 2019. And for those that didn't see, we did publish a thematic last week on the hardware side. We're now looking for smartphone and PC sales to decline in both 2022 and 23, largely driven by issues at the low end of the market for both those industries, while the high end of the market, as well as the enterprise, continues to hold up somewhat well. Next slide. So this is just a quick breakdown on the current state of the semi industry and our outlook ahead. The bottom left chart just looks at the current revenue breakdown by industry. Like I said, 40% of demand still comes from PCs and smartphones, both likely to decline the next 2 years. But we still forecast 9% growth here for semis in 2022, before likely leveling out to about 0 to 3% growth here in 23. Now, the growth for semis over the next 2 to 3 years and decade, we think will be driven by data centers, which is growing north of 30% this year, as well as autos and industrials. Both those segments are growing north of 25% this year. And the real key behind those 3 markets really going to be on the content growth per device more than the actual unit side of things. And you can see that on the top left just shows the split of semi revenue between memory and non-memory. Memory is its own beast, about 30% of semi revenue, but long term we think grows 5%, but it's going to have issues here over the next couple of quarters. We do see some prices rolling over on both the NAND and DRAM side of things later this year, and customers are just being more conservative with purchases, and the industry really sits with an ample amount of memory at the moment. Now, on the memory side of things, we're a bit more optimistic, long-term 6 to 7% growth, and accelerators inside the data center like GPUs, ASICs, FPGAs being kind of the fastest growers over the next decade there. Next slide. I think this is just an important chart and really looks at the semiconductor content per system by end market. So if you want to know where to be exposed within semis, this chart really tells you where you need it to be and where you need to go, how to be kind of positioned, right? So the chart here uses 2020 as a base year, so that red dotted line, while the shaded blue just highlights 2022 and beyond, so the forecast year out. Now, it compares the 4 biggest markets for semis, PCs, phones, data center servers, and autos. For example, the greatest content growth the last 4 years actually came from phones, which is that orange line. And that's largely driven by Apple's shift from 2 to 3 and now 4 phones shift to 5G, of course, over the last 2 years. And it was for these reasons that we were bullish on names like a Skyworks and a Qualcomm over that time period, which we've downgraded over the last year, as the content growth on the mobility side has largely played itself out. And you kind of now, if you can see how the levels have kind of leveled out in that blue shaded area. Now, if you kind of look ahead within that blue shaded area, you can tell that the greatest content growth will come on the server, data center server, and the automotive side for reasons kind of we should all know, EVs, among other regions. But our recommendations really line up in these categories, especially the wallet share gainers. Now, the next slide here. This just comes from a semis piece we wrote back in mid-March, where we laid out the 8 biggest risks for the industry. Geopolitical risks dominate the top of this list. So a future Taiwan attack by China is the single biggest risk right now. Taiwan controls over 50% of the total foundry capacity, over 90% of the chip manufacturing for advanced products. So a potential attack by China in Taiwan could make producing final products like iPhones essentially impossible to do. China also a major risk that we highlighted in our March report. with China's plans to create greater self-sufficiency from U.S. chip makers, basically building its own local semi-industry, as our biggest concern. But by doing so through an uneven playing field. And now the rest of the risk here really on the list are more cyclically driven, somewhat correlated. So, think about if we see greater inflationary pressures, puts us in a global recession, lead times obviously would come down and potentially puts pricing at the foundry level at risk and potentially at risk of rolling over, especially as we see record levels of CapEx spend being spent today. So, that's typically how cycles end before new ones start, and probably kind of the bear case scenario out there in the market right now. Now, turn to the next slide. This is just my last slide. This is just our top picks focused on data centers, autos, industrials. Those first 4 names on the list are, your data center plays, names that we like a lot that we think can actually grow top line at 20 or grow top line 15 to 20% annually, get mid-teens or mid-20% earnings growth aside from Broadcom. Broadcom, we do still like. We downgraded it from a strong buy to a buy. We like the pending acquisition of VMware. It is margin, EPS, free cash flow accretive. Now 50% will become 50% software, so it reduces the cycle risk for Broadcom. The concern that we have for Broadcom now is they're going to have over $70 billion in debt, really limits what they can do in terms of further deals going forward, and potentially puts a conglomerate type of multiple on the stock. So less upside potential in Broadcom, and kind of why we downgraded it. Now, the other 2 names on the list, NXP, onsemi, those are more your kind of auto type names, automotive names, and those have actually been the outperformers this year because of the lower multiple, clearly, but we think those are the best strategically positioned from a portfolio, a product perspective going forward. So I'll leave it at that. I'll now turn it over to Nick for our legal commentary.
All right, thanks, Angelo. I'll zip through this quickly and we'll move to Q&A. So I'll first give a high-level view and then cover some company-specific points on each of the 4 major US tech platforms. So on the high-level point, sorry, next slide, please. Our team has covered the legal, regulatory, and policy issues surrounding the US mega cap tech platform space since mid-2018. That includes issuing thematic reports on risk and disclosure, reports on and alerts covering antitrust lawsuits, and a lot of other subjects. Just a quick word on our rating system. So in our process, we assign legal risk and opportunity, or we assess legal risk and opportunity, and we make an effort to compare our view to buy and sell side consensus with the kind of overarching aim of identifying mispriced risk, and that can be in either direction. We had a pretty significant event when the US Senate flipped blue in January 2021. We issued a regime change type report on the tech platform space. Our basic thesis was that the 4 dominant US tech platforms as a group would likely underperform the broader market over the next 12 to 18 months. And kind of fast forward where we're at today, an equal weighted basket of our negative calls on those 4 platforms has actually outperformed the S&P by about 9% through June 12th. So that regime change call remains in place today, with one exception, and that is Meta Platforms. We shifted to a neutral view on Meta after their very significant derating in February. So a little more on our current view. Our view is that legal risks have not yet been imputed to the 3 of the 4 tech platforms. Instead, we believe the underperformance year to date and going back really to the January 21 call is primarily driven by non-legal factors, so macro issues, lower multiples, of course, being assigned to long duration tech, et cetera. We think that has predominated, but at the same time, we've kind of witnessed a backdrop of steadily rising legal and policy risks. And so we also think that in this new environment that we're in, investors generally are going to start to pay a lot more attention to risk generally, not just legal risk. And so these concerns, we think, are magnified in the current environment. Our outlook assumes no meaningful U.S. antitrust legislation, although the odds of that, of meaningful legislation being passed, seem to be ticking at least somewhat higher, with either one or both of the Open App Markets Act and America Choice and Innovation Act, which both were featured in a almost 30-minute John Oliver episode a few days ago. It seems to be cracking into the zeitgeist a bit that these issues are important and could be actually addressed by the current Congress. So we'll see. That would represent further risk in our view. So going forward, we're also focused on identifying companies that could benefit from this stepped up legal scrutiny of the major tech platforms. And this kind of syncs up with Sam's observation earlier about how the technology sector could become interesting in a lower growth environment. Perhaps we could see small and mid-cap companies that benefit from the scrutiny on major tech platforms benefit significantly in this environment. Next slide, please. All right, turning specifically to Apple first. So we think Apple faces a constellation of legal policy and litigation risks, and those touch on two crucial profit centers for the company. One is what we call a joint venture with Google in the advertising area, and then the other is, of course, App Store revenue. And together, these pools of profit represent around 30% of consolidated company profits. So we also think that the company's multiple expansion dating really to late 2018, 2019, it rests on a somewhat unsteady foundation, given that we have these concerns about the App Store and Google ad partnership, and those are significant drivers of the services business. Also with Apple, and as Angelo alluded to earlier, we think Apple faces some unique tail risks that are not shared by some of their, or really any of their mega cap tech platform peers. And the most obvious point there is the tensions around China and Taiwan, geopolitics, and supply chain. On the topic of privacy and security, I think what we're seeing is more scrutiny of Apple's justifications for its policies, including its App Store practices and policies. Those are being challenged as being at least partly pretextual, and we think there's some support for those arguments upon close examination. There's also a point that's frequently made by developers that Apple already reaps significant benefits from developers, even if you assume zero commissions or 0% commissions paid by developers, namely helping Apple to sell high margin iPhones. We think a kind of validating or confirming point on the risk picture for Apple is what we're seeing from Microsoft. Strategically, Microsoft seems to be positioning to take advantage of this shifting backdrop. And we look at the company's Microsoft's acquisition or pending acquisition of Activision as basically a bet against the sustainability of Apple's App Store policies long term. In terms of things to kind of be looking for, we think the DOJ could well bring an antitrust lawsuit against Apple sometime, even in the second half of this year. We're seeing significant tension between the DOJ and Apple, who is a third party in the DOJ's lawsuit against Google, but is frequently present on hearings that we're listening in on. We think that that risk would actually go higher if there's clarity that there won't be significant antitrust legislation passed here in the US in the second half of this year. All right, next slide, please, on to Amazon. So Amazon represents a really interesting company in this backdrop of increased antitrust scrutiny. Traditional US antitrust orthodoxy focuses on price and price increases as the measure of antitrust injury. Amazon's "your margin is my opportunity" ethos obviously kind of makes things challenging for regulators and policymakers, and they are turning to more creative theories of harm, which include self-preferencing and predatory pricing, new theories of predatory pricing that kind of fall outside the traditional rubric. Amazon began warning investors last October that it faces, quote, a number of open investigations, and they've called out several inquiries that are going forward currently in Europe. One potential crack in Amazon's antitrust armor could be seen from a decision coming out of a federal court in Washington in March, which largely denied or rejected Amazon's attempt to throw out an antitrust case that's predicated on Amazon's most favored nation pricing policy that's imposed on third-party merchants. Another area to watch is the ad business of Amazon, which is growing rapidly and seems to be an important contributor to growth for the company in recent quarters. There could be some scrutiny directed towards that business coming out of the FTC. So we'll see what happens in that space. Another major risk for Amazon is labor related. An area that we cover separately is gig companies, Uber, Lyft, DoorDash, and others. And Amazon shares some of those risks, namely around the risk of unionization and that their independent contractor drivers and other workers could be deemed employees. In terms of a next shoe to drop, we're looking out for a potential FTC antitrust lawsuit against Amazon, potentially sometime in the second half. At this point, the FTC has a full complement of commissioners with the addition of Commissioner Bedoya, and they have a 3-2 majority and some impetus to move forward perhaps before potential changes in the composition of Congress late this fall. All right, next slide, please. I'm going to turn to Alphabet. So when we kind of add up the cumulative impacts of the various provisions of the EU's Digital Markets Act, we see Google as kind of in the pole position. They take the most direct hits from the DMA. We believe European competition officials and policymakers learned a lot from over a decade of litigating with Google in a series of antitrust cases, and perhaps that those lessons are packed into the DMA's various provisions. One thing to note in particular, taking to heart Justice Brandeis's observation that sunlight is the best disinfectant, the DMA imposes remarkably invasive transparency requirements on Google in terms of their advertising business, provides granular information for advertisers and publishers regarding pricing, remuneration, performance of ads, etc. The DMA also covers search engines, app stores, and a host of other issues. And one little notice provision could provide enforcers the ability to bring an immediate lawsuit, which is similar to a preliminary injunction here in the US, to force changes in conduct pending further investigation. We haven't seen much attention paid to that, but it could be pretty powerful in the hands of an aggressive regulator. Another thing to flag on Google again is this litigation with the DOJ, and it's really the centerpiece of that litigation is the Google-Apple relationship around kind of this ad search partnership. The DOJ is laser focused on how that agreement came to be, what the terms of it are, historically and today, and how that could have helped Google maintain their search monopoly here in the U.S. The DOJ's dogged pursuit of documents and testimonial evidence from executives at both companies relating to this arrangement is especially noteworthy in our view. So last point on Google is on the the Google Play App Store front. You have a lot of litigation in that area, including lawsuits brought by Match and Epic. There was a recent kind of showdown where Google was poised to force Match and Epic to exclusively use Google Play billing as of June 1. That was challenged by Match and a company that Epic Games acquired called Bandcamp, and ultimately Google blinked, and the status quo will kind of stay in place pending litigation or pending trial in the spring of next year. And that will allow, with the status quo, Match and Epic can continue to use their own payment processing methodology instead of using, or system instead of using Google's. So that's it on Alphabet. Lastly is Meta. So maybe the place to start with Meta is the stunning nearly over $250 billion single day drawdown in their share price, and which we think is a warning that even dominant U.S. tech platforms can suffer very significant reversals as investors move to price in long building risks. So our current view on Meta is that very significant legal related risks have been imputed to the company's investment case and stock price. This includes an inability to conduct meaningful M&A, the urgency and risk associated with building rather than buying the next hot social media app or platform, Apple's various privacy pronouncements and policies, and the FTC's ongoing antitrust case, which seeks to unwind the Instagram and WhatsApp acquisition. So we effectively have a neutral view on Meta at this time. An area to watch going forward is, of course, the fireworks between Meta and Apple. They're really engaged in open warfare over Apple's ATT and privacy policies, and we think that Meta is going to shine a bright light on Apple's own interest in adopting its privacy framework. So look with popcorn at your side for more to come in that area. Last thing here with Meta is to keep an eye on the UK Competition and Markets Authority, the CMA. They're doing very detailed work in the mobile ecosystem space. They issued a report and supporting analysis last week that totals into the thousands of pages, which concluded that Apple and Google have a, quote, stronghold on the mobile ecosystem. So we're going to watch this space carefully, as we think the CMA is arguably most advanced among global regulators in its study and analysis of the mobile industry. The last slide here is just we list out some upcoming dates and catalysts to keep an eye on moving forward. Thanks a lot, and I'll turn it back over.
Thanks, Nick. And we are past the hour, so we're going to just handle just a few questions. And starting with Sam, should we get a bear market that mimics the averages associated with the recessions? What would be some targets or time frames we should think about?
Well, Ken, let me give you two numbers there. One is if we were to go specifically on history, meaning that we saw a bear market that lasted 15 months and stripped off 35%. History would say that we would reach the 3118 level on the S&P 500, down near the 68% Fibonacci retracement level. The bear market would conclude in early April of next year, but a new bull market would start in late July of next year. But we would have to wait until May of 2025 to recoup all that we lost in that prior bear market. So that, I would say, is an extreme case scenario, which would be a 35% price decline over 15 months. But then bull markets tend to come back very quickly within 3 months. I think this time, as I mentioned before, that the S&P will probably fall about 27% to the 3,500 level. But then again, applying the fact that bull markets usually start about 3 months after the bear market has ended, we could see this market at 4,200 by the end of this year, and then up to around 4,675 by this time next year, recouping all that we lost by the end of 2023, early 24.
That's great. We'll take it. Vincent, your team definitely shifted to defensive last summer. What did you see then? And if you want to dabble, what will be the support levels of the S&P 500, the final support levels that possibly we can see before we move from bear to bull market? Vincent?
Yeah, thanks, Ken. It's a good question. And I think, just to start, it's important to know that we understand, just based on our history, that tops are processes, and often long ones. So starting in July of last year, we were already getting those crossovers between selling pressure above buying power, making supply dominant. But those crossovers at that time were pretty brief, and there were still enough stocks participating according to our other indicators that we didn't need to go and say, hey, you need to go to cash. But during that time period, what we did say was that the process of the top was starting. In other words, the bull market was losing membership, meaning that investor portfolios would need to be more selectively focused on relative strength, and particularly large cap stocks, to reflect that view. And it wasn't until January 18th when we got an intermediate trend, a Lowry intermediate trend sell signal, that we made the call to outright start to raise cash and pursue other defensive strategies. And what made that significant was the fact that, in addition to the negative divergence that we had already seen, as we've talked about in this conversation, in our sensitive core indicators for months before, we also had witnessed a 2-month negative divergence in breadth, which does typically precipitate bear markets, corrections, bear markets of all depths, right? So since then, despite the glimmers of hope along the way, and even periodic short-lived crosses of buying power above selling pressure, we continued to heed the full weight of market evidence since then, which reiterated the same approach, and referring to the March and the late May rallies as relief rallies, which it looks like they ended up being in the context of an ongoing trend of deterioration. So patience and cash are basically more important than they've been in years. And then as far as trying to estimate exactly where in terms of price all these things are going to line up, if you look at some of our indicators, what we're doing is we're talking about, for example, where are individual stocks relative to their moving averages. So you have a lot of math to do that's really impossible, because you've got moving targets on top of moving targets on top of moving targets. So I would just say it's over when the buyers say it's over. And the good news is we've got the tools to identify major market bottoms, and we've done it. We've done it since 1938. So we'll just have to find out and see what the market tells us.
Great. Angelo, last one for you. semiconductors stocks, will those valuations, PEs, stay cheap because we have recession? Or you have a pretty compelling bull case here, whether it be the new secular trends of demand plus M&A. And so how do you play this? Do you wait?
Yeah, I mean, listen, I think it's difficult to wait. I don't think we've necessarily seen a bottom, but it's impossible to tell when a bottom actually takes place, right? I think as far as the fundamentals for the semiconductor industry is long-term structurally has improved because of what's going on in the data center. So if you look at just last year, the data center was only 13% of semiconductor revenue. This year, it'll be 17, 18% of semiconductor revenue. A year, 2 years from now, it'll be north of 20%. And I think, also importantly, autos and industrials, the content growth you're seeing there, about 10 to 11% of semiconductor sales last year. In a decade from now, we think autos are north of 20% of semiconductor sales. So that content growth story is absolutely unbelievable within the semi side of things. And you don't necessarily need to see the unit growth across these end markets for semis to continue to grow. Now, as far as kind of multiples are concerned and what have you, historically 18 times has been the average multiple for semis. Even if we were to see something, closer to 15, 16 times, given where we are today in the market, I mean, it still would demonstrate it. And given the growth we're looking for the industry, I think even at these levels, I think at some point in time, you're going to be extremely happy investing at these type of levels. Again, impossible to tell where we see a bottom in these type of names, but seeing these names drop by a third represents probably the most compelling opportunity we've seen in a decade within semis.
Great. Dawn, if we can move to the next slide. And as we do that, want to note on the upper right side for registrants, we have 5 handouts, which is research from our presenters today. To learn more about fundamental research, Lowry Research, or Legal Edge, you can see that you can go to each of these sites to get more information or access to our research. Most important, I want to thank everyone for their valuable time to share CFRA's views about the market, technology, and semiconductors. Everyone enjoy the rest of your day, and we look forward to speaking to you soon. Thank you.